Hello everyone, welcome to Thursday. We had a gap down, open, went down for the first hour and then essentially rallied for the rest of the day. We hit more or less the bottom of the range and then bounced off of that, so that's good. The range that we've been in for several weeks now is still holding up. Our number one holding today, again for the second day in a row, was our long-term Treasury Hedge. Just quickly talk about that. In times of stress, people will run with their money to safe havens, and the U.S. Treasury is definitely one of those, if not the biggest one. And so you can buy what's called an inverse if you're trying to hedge your portfolio. So they have an inverse that goes exactly opposite direction of the S&P 500. And so that's a way to hedge. The problem is when the market recovers, it goes exactly the opposite. And with treasuries, the extended duration treasury that we have actually has a 12.2% average rate of return over the last 10 years. So it's not a bad investment. Now, that's because interest rates came down. It might not continue to make that. It's also very volatile. It's almost as volatile as the S&P 500 according to Morningstar. But the longer duration that you go, the more pop that you get and the less that you have to use. And so like short-term treasuries that I'm following according to Morningstar were up 3%. Medium term were up 8%. Long term were up 22%. And this extended duration treasury that we own is up 30% for the year. And so I like that. I think it's a good mixture. We also have short-term treasuries in these portfolios, especially as we get more conservative with the portfolios. But the hedge is there to help us if the markets fall, especially when they fall really fast and you don't have a chance to get in there and make some changes. So we've already got that in place and we're ready to go either direction. So that's our story today. Look forward to talking to you tomorrow. Thank you very much.